In 1923, a German professor walked into a store with a wheelbarrow full of cash to buy a single loaf of bread. By the time he reached the counter, someone had stolen the wheelbarrow and left the money behind. Think about that. The cash was worthless. The wheelbarrow had value. That single moment captures something most people never truly understand about money, about security, and about the things we trust to protect us. Because here is the uncomfortable truth. The assets we believe are safest are often the first to fail. History has confirmed this in Germany, in Argentina, in Zimbabwe, in Cyprus, in Greece, and in dozens of other economies across more than a century. Today, we are going to look at 10 things that become completely worthless during an economic collapse. Some of them will surprise you. A few might make you rethink decisions you're making right now. But before we get to the list, we need to understand exactly how ordinary people get caught off guard when the system around them begins to unravel. For that, we go to Buenos Aires, December 2001. A woman we will call Elena had spent 12 years building a modest savings account. She worked as a school administrator. She was careful with money. She had never missed a payment. She did not speculate in the stock market. She did not take on excessive debt. She simply saved a portion of every paycheck, year after year, in a regulated bank she had trusted for her entire adult life. She had plans for that money, not extravagant plans, a small renovation on her apartment, retirement security, perhaps a modest holiday with her family in the coming year. None of that seemed unreasonable. None of it seemed risky. It was exactly the kind of responsible, conservative behavior that every financial advisor in the world would have praised. On the morning of December 3rd, 2001, she turned on the television and saw crowds outside her bank. Police were blocking the entrances. The president had just announced that the government was freezing all bank accounts in the country. The measure, known in Spanish as the corralito, restricted all cash withdrawals to 250 pesos per week. Elena could not access her savings. She could not pay her mortgage. She could not buy groceries beyond the small amount of cash she had at home. For weeks, the number in her account existed only as a figure on a screen. Completely real. Completely inaccessible. When the freeze eventually lifted, the government forcibly converted dollar-denominated savings into pesos at a fixed rate. The peso then collapsed in value almost immediately after. 12 years of savings, reduced to a fraction of their worth, not through any decision Elena made, through a government decree responding to a crisis she had never caused. Elena's story is not unique. It is one version of a story that has repeated itself in country after country for more than 100 years. Because what every economic collapse reveals is something deeply uncomfortable. Most of the things we believe have value do not have inherent value. They have value because of trust, because of functioning systems, because of collective belief in institutions. When any of those conditions disappear, the value they sustained disappears with them. And crucially, in every single case, ordinary people were the last to understand what was happening and the least equipped to protect themselves from it. A simple factory worker in Zimbabwe did not cause hyperinflation. A Greek pensioner did not cause the sovereign debt crisis. A Cypriot depositor did not cause the banking collapse. But all of them absorbed the consequences. This is the hidden pattern of economic collapse. The people who created the conditions that drove the crisis rarely pay the heaviest price. And the people who simply trusted the system often lose the most. Understanding this pattern is not about predicting when collapse will happen. It is about understanding which things hold their value when systems fail, and which things only appear to hold value because the systems are still working. So let us begin. What are the 10 things that become worthless first? Number 1, paper currency issued by a collapsing government. We tend to think of cash as the ultimate safe haven. It is physical, it is tangible. But paper currency is, at its most fundamental level, a promise. A government promise backed by confidence in the institution making it. When that confidence collapses, the promise means nothing. The most extreme modern example is Zimbabwe between 2007 and 2009. Annual inflation reached an estimated 230 million% by mid-2008, according to International Monetary Fund assessments at the time. The Reserve Bank of Zimbabwe printed $100 trillion notes. Some street vendors refused local currency entirely, demanding payment in South African rand or US dollars instead. There are photographs from that period that remain genuinely difficult to comprehend. Supermarket shelves photographed in the morning next to their price tags, then photographed again in the afternoon with prices that had already tripled. Workers demanding to be paid daily, sometimes twice daily, because the value of their wages was visibly declining between morning and evening. Economists studying the period documented cases of businesses that abandoned price lists entirely and simply negotiated each transaction individually based on how the currency had moved that day. But here is what most accounts miss. It did not happen overnight. There was a long period of slow erosion before the catastrophic collapse. Prices rose weekly, then daily, then hourly. Each round of increases felt like a temporary problem that would pass. And then one day, the velocity of collapse crossed an invisible threshold, and there was no coming back. This pattern is the signature of every hyperinflationary episode in modern history. Weimar Germany in the early 1920s, Hungary in 1945 and 46, when prices doubled every 15 hours at the peak, the fastest inflation ever recorded in any modern economy. Yugoslavia in the early 1990s. In every case, the people most severely damaged were those who had worked hardest to save in their national currency. It is a brutal inversion of everything we are taught about financial responsibility. The harder you work to save, the more you trusted the currency, the more you accumulated in the banking system, the heavier the losses when the system finally broke. Number 2, long-term savings accounts and fixed bank deposits. The Elena problem. The money does not literally vanish. It becomes inaccessible, forcibly converted, or quietly destroyed through inflation. Sometimes all three at once. During the Greek debt crisis, capital controls imposed in July of 2015 restricted withdrawals to 60 euros per day. You could have 100,000 euros in savings and still be unable to pay your monthly bills. But Cyprus showed the world something even more alarming. In 2013, as part of a bailout negotiation with the European Union and the International Monetary Fund, the Cypriot government imposed what became known as a bail-in. Depositors with savings above 100,000 euros at the Bank of Cyprus had approximately 47% of their deposits above that threshold converted into bank equity, which quickly became largely worthless. It was not a tax, it was not a market loss, it was a legally mandated seizure of private savings used to recapitalize a failing bank. And crucially, the framework established in Cyprus was subsequently used as a model in European banking legislation. Several major economies updated their bank resolution frameworks to include similar mechanisms in the years that followed. The vast majority of savers in those countries have no idea. Number 3, residential and commercial real estate in certain markets. Property is consistently presented as the ultimate store of value. Land is finite. Housing is a basic human need. Values fluctuate but always recover. The argument is compelling in normal times, but history does not reliably support it during systemic collapse. Japan's asset price bubble peaked in the late 1980s and began collapsing in 1991. Property prices in major Japanese cities fell by 50 to 60% across the following decade. In some central Tokyo commercial districts, values fell by over 70%, according to data from Japan's Ministry of Land, Infrastructure, Transport, and Tourism. The collapse was so severe and so prolonged that it became the defining feature of what is now called Japan's lost decades. Banks that had lent heavily against property values found themselves holding enormous portfolios of loans secured against assets now worth a fraction of the original valuations. They stopped lending, credit froze, and the entire Japanese economy entered a deflationary spiral that lasted for the better part of 20 years. What was supposed to be the safest asset in a prosperous society became the anchor that dragged the entire financial system down. But the hidden danger in real estate during a collapse is not simply that prices fall. It is that liquidity disappears entirely. Banks stop lending. Buyers cannot get mortgages even if they want to buy. The transaction market effectively freezes. If you own property with a mortgage attached and you need to sell, you may find yourself trapped with an asset worth far less than your debt and no viable way out. The asset becomes the trap. Number 4, stocks in structurally vulnerable sectors. Equity markets during collapses behave in complex ways. In hyperinflationary environments, nominal stock prices can actually rise as each unit of currency loses value. This happened in Weimar Germany and in Zimbabwe. Investors who watched their portfolios rise in nominal terms sometimes discovered they had still lost purchasing power in real terms. But in deflationary financial crises, the collapse can be brutal and rapid. In 2008, Lehman Brothers shares fell from around $65 to essentially zero in a matter of weeks. Washington Mutual, the largest thrift institution in American history, saw its stock become worthless when regulators seized it in September of 2008 in the largest bank failure in American history up to that point. Bear Stearns, which had traded near $170 per share in early 2007, collapsed to $2 per share by the time its emergency acquisition was completed in March of 2008. What the 2008 crisis demonstrated with devastating clarity was that entire interconnected sectors could collapse essentially simultaneously. Banks, insurance companies, real estate developers, mortgage originators, they were all connected through complex instruments that created shared exposure to identical underlying risks. When the system tipped, it tipped across all of them at once. The diversification that was supposed to protect investors provided almost no protection at all. The 2008 crisis also revealed something that many investors had not fully appreciated before: correlation risk. The idea that assets which normally move independently can suddenly move in the same direction at the same time when systemic stress reaches a certain level. A portfolio that looked diversified during stable periods turned out to be deeply concentrated in the one thing that mattered most when panic set in: trust. When trust collapsed, every sector that depended on trust collapsed with it. Number 5, insurance policies held with insolvent providers. People spend decades paying premiums, building what they believe is a comprehensive safety net. Insurance works by pooling risk across a large number of policyholders and holding reserves sufficient to pay expected claims. The entire system depends on those reserves being real, being liquid, and being available when needed. In Argentina's 2001 and 2002 crisis, several insurance companies became insolvent as the broader economy deteriorated. Policyholders who had paid faithfully for years found that their coverage was backed by reserves that no longer existed in any meaningful form. Claims went unpaid. Policies became paper without practical value. In environments of sustained hyperinflation, life insurance presents a particularly cruel problem. A policy written to pay out an amount designed to cover significant expenses at the time of signing may, by the time it is triggered, pay out a nominally identical sum that is worth almost nothing in real purchasing power terms. The numbers on the policy never change. The purchasing power behind them collapses silently beneath them, and policyholders rarely realize what has happened until they try to claim. Number 6, pension funds with concentrated exposure to government bonds. The foundational promise of a pension is simple: contribute consistently throughout a working career, receive a reliable income in retirement. That promise is only as good as the investments backing it. The prevailing logic for decades has directed pension funds toward large allocations in government bonds. Sovereign debt from stable governments has been considered among the safest assets in the world. Default seemed effectively impossible for major economies. Argentina's 2001 default challenged that assumption with brutal force. When Argentina defaulted on approximately $100 billion in public debt, it was the largest sovereign default in history at that time. Pension funds holding Argentine government debt suffered devastating losses. Greece provided a more recent case study. As part of the restructuring of Greek debt in 2012, private sector bondholders, including pension funds, were required to accept a 53.5% reduction in the face value of their bond holdings. This became known as the private sector involvement. For Greek pensioners, this meant retirement income reduced sharply through a process they had no power to influence and no practical ability to avoid. This is one of the most painful dimensions of economic collapse. The people who did everything right, who contributed through their entire careers, who planned carefully, they can find themselves with far less than they were promised. Not because they gambled, not because they were reckless, but because the system itself failed. And this gets to something important. The safety of a pension is not determined by the individual. It is determined by the solvency of the fund, the creditworthiness of the governments whose bonds the fund holds, and the willingness of legislators to honor commitments made to workers decades earlier. Each of those factors is entirely outside the control of the person who spent a lifetime contributing. Number 7, the market value of highly specialized professional skills. This is the item that receives the least attention in discussions about economic collapse, and it may be among the most consequential in terms of how it reshapes people's lives. During periods of severe economic contraction, entire industries can contract sharply or disappear within a short period of time. The specialized skills required for those industries do not automatically transfer. After the dissolution of the Soviet Union, millions of scientists, engineers, military technicians, mathematicians, and academics found themselves in an economy with no mechanism to reward their expertise. The state institutions that had employed and valued them either collapsed or ceased paying meaningful wages. Private markets, still forming and deeply unstable, had limited demand for their specific capabilities. A nuclear physicist or aerospace engineer in Moscow in 1993 might have been among the most technically accomplished human beings on Earth. Their skills were real. The economy around them simply had no functioning mechanism to translate those skills into income sufficient to support a family. The Greek crisis produced a different but equally painful version of the same problem. Between 2010 and 2018, Greece experienced one of the largest emigration waves of educated professionals in recent European history. Doctors, engineers, lawyers, and academics left in large numbers because their genuine skills had no adequate purchasing power in a collapsed domestic economy. Estimates from Greek research institutions and international organizations suggested that several 100,000 young educated citizens emigrated during this period, representing an enormous loss of human capital that had taken decades of investment to build. Number 8, consumer loyalty points, airline miles, gift cards, and stored value instruments. These feel like minor items compared to pensions and real estate, but the scale and the mechanism are worth taking seriously. Airlines, retailers, hotel chains, and credit card networks collectively issue what amount to enormous quantities of private currency. frequent flyer miles, hotel points, store credits, gift cards, prepaid balances. These instruments are, in most jurisdictions, entirely unsecured and uninsured obligations of the issuing company. If the company fails, these instruments typically become worthless immediately. When airlines and major retailers moved toward insolvency during the 2008 financial crisis, customers holding loyalty points and gift cards found themselves among the most junior creditors in bankruptcy proceedings. In practice, this often meant they received nothing at all. More broadly, any stored value instrument denominated in a collapsing currency loses real value even if the issuing company itself survives. If the currency collapses, the purchasing power of points denominated in that currency collapses with it. The global loyalty program market is enormous. Most people have no idea how exposed they are if the backing currency or backing company fails. Number 9. The goodwill and intangible value of established businesses. When analysts value a business, a significant portion of the total valuation typically comes from intangible assets, brand recognition, customer loyalty, established supplier relationships, proprietary systems, the reputation built across years of consistent operation. In stable markets, this intangible value is real. It translates into pricing power, customer retention, and competitive advantage. In a collapsing economy, it evaporates with disturbing speed. Brand loyalty disappears when consumers have no purchasing power. Supplier relationships break down when suppliers themselves are under severe financial stress. Network effects that made a platform or marketplace valuable can reverse violently when participants flee. Lehman Brothers presents the sharpest possible illustration. When Lehman filed for bankruptcy on September 15, 2008, the firm had been in continuous operation for 158 years. It had survived the American Civil War, both World Wars, the Great Depression, every major financial crisis of the 20th century. Its brand was among the most recognized in global finance. Its client relationships spanned decades and multiple continents. Its institutional history represented accumulated goodwill built across a century and a half of market activity. 158 years. Gone in less than 72 hours. Every relationship, every reputation, every year of accumulated history. Worthless the moment the underlying trust evaporated beneath it. And here is the detail that matters most. In the days before Lehman filed for bankruptcy, its executives were still trying to negotiate a rescue. Potential acquirers were still conducting due diligence. Regulators were still meeting through the weekend trying to find a solution. Because even at that late stage, everyone understood that if Lehman had been saved, its brand, its relationships, its history, all of it would have still had enormous commercial value. The goodwill was real. The problem was that it could only exist within a functioning trust environment, and that environment had collapsed beneath it. Number 10, and this is perhaps the most profound item on the list, social capital. The invisible web of trust, informal agreements, institutional credibility, and shared expectation that makes economic activity possible at all. Social capital does not appear on any balance sheet. It cannot be bought, sold, or insured. But it is the foundation on which every other form of economic value rests. Formal contracts are only enforceable when the institutions enforcing them retain credibility. Credit markets function only when lenders can reasonably predict future solvency. Informal agreements that reduce friction in everyday commerce become worthless when shared expectations about the future collapse. The entire economy is, in a deep sense, a coordination mechanism built on the assumption that other participants will behave predictably. When social capital erodes, that coordination breaks down. Venezuela's economic crisis, which began accelerating visibly around 2013, offers one of the most documented modern examples. As the formal economy contracted and eventually ceased to function reliably for much of the population, economic activity reorganized itself around informal networks. Barter, dollar transactions, conducted entirely outside the banking system, personal trust networks among family and neighbors. These informal mechanisms provided survival structures when the formal economy failed, but they could not replicate the scale, efficiency, or growth potential of a functioning formal economy. Social capital, once depleted, is among the slowest things to rebuild. Studies of economic and social trust following major crises consistently find that affected populations carry significantly lower institutional trust for a decade or more after the technical economic recovery has occurred. This depressed trust is not irrational. It is the rational response of people who trusted institutions, followed the rules, and still lost large portions of what they had built. The economic consequences of depleted trust, in terms of reduced investment, constrained credit, and weakened economic coordination, can persist for a generation. The scars from the collapse of social capital outlast almost every other form of damage. And so we arrive at the deeper question underneath all 10 items on this list. Why do collapses expose these vulnerabilities so completely and so suddenly? How can things that felt solid and permanent become essentially worthless in a matter of weeks? The answer lies in the distinction between intrinsic value and assigned value. Intrinsic value is the value something possesses independently of collective belief, legal structures, or institutional support. Clean water has intrinsic value. Food has intrinsic value. Shelter from the elements has intrinsic value. These things are valuable regardless of what any government decides or what any market believes at any given moment. Assigned value is the value conferred on something through shared belief, legal convention, and institutional backing. Paper currency has assigned value. A pension promise has assigned value. A stock certificate has assigned value. A brand has assigned value. An insurance policy has assigned value. Even many professional skills have assigned value that depends entirely on the continued functioning of the economic sectors that create demand for them. The entire architecture of modern finance is built almost entirely on assigned value. And assigned value rests on one thing above all others: trust. Trust in institutions. Trust in legal systems. Trust in the competence and good faith of the people managing the mechanisms of economic life. And here's the thing most people never stop to consider. We rebuilt the entire global financial system on assigned value by choice because it is extraordinarily efficient in stable conditions. Assigned value allows for paper currencies that are far easier to transact with than gold or barter. It allows for credit systems that can fund factories and infrastructure decades before the revenue from those projects arrives. It allows for insurance, for pensions, for complex financial instruments that coordinate the savings of millions of people toward productive investment. All of that is only possible because of trust, and all of it becomes fragile the moment that trust is questioned. When that trust collapses, assigned value collapses with it, and the speed at which trust can evaporate continues to surprise even the most experienced observers. Consider this. In the months before Lehman Brothers failed, the firm passed multiple regulatory stress tests. Its credit ratings remained investment grade. Sophisticated institutional investors were still lending to it. Governments were not anticipating its failure. And then within a matter of days, it was gone. Not because new information suddenly appeared. The underlying problems had been building for years. But because the moment one large creditor decided the situation was unsustainable and refused to roll over its loans, the collective belief that had been sustaining the firm evaporated almost instantly. Trust, it turns out, is not a gradual thing. It can exist fully one day and be completely absent the next. In the weeks following Lehman Brothers' failure in September of 2008, the global interbank lending market came close to freezing entirely. Banks stopped lending to each other, not because the rules had changed, not because money had literally disappeared, because banks no longer trusted each other enough to lend. The confidence that had allowed the system to function smoothly for decades had simply evaporated. The emergency policy responses that followed were extraordinary by any historical measure. The United States government took effective control of Fannie Mae and Freddie Mac. The Federal Reserve created emergency lending facilities with no historical precedent. Interest rates were cut to near zero and remained there for years. The Federal Reserve's balance sheet expanded from roughly $900 billion before the crisis to over $4 trillion by 2015, as it purchased assets to inject liquidity into a system that had lost its internal trust mechanisms. These were not routine policy adjustments. They were emergency interventions designed to replace private trust with institutional credibility when collective confidence had failed. And here is what that tells us about the nature of the modern economy. The 2008 crisis did not happen because the physical economy of the United States broke down. Factories were still standing. Workers still had their skills and knowledge. Natural resources still existed. The productive capacity of the economy remained real. What failed was the financial and institutional layer that coordinated all of those real assets. The trust layer, the system of assigned value that connected production to consumption, savings to investment, and present activity to future expectation. When that layer failed, the real economy began to follow it. We are prone to thinking that collapse is something that happens to other countries. Countries with weaker institutions, countries with poorly managed fiscal policies, countries without the sophisticated frameworks that modern economies possess. But the mechanisms that can drive collapse are not unique to any geography. They exist wherever assigned value is built on collective trust. Every currency depends on trust in the institution that issues it. Every bank deposit is, legally, a loan from the depositor to the bank, not an ownership claim on a specific sum of money. Every pension depends on the solvency of the fund and the governments whose bonds back it. Every stock price reflects collective belief as much as underlying value. The German professor, with his wheelbarrow in 1923, was not living in a primitive or poorly governed society. The Germany of that era had world-leading universities, sophisticated financial markets, major industrial corporations, and one of the most culturally and scientifically advanced civilizations on Earth. None of it protected the paper in his wheelbarrow. History has a patient and consistent lesson embedded in every collapse, from Rome's systematic debasement of its silver coinage to Argentina's frozen bank accounts. from Cyprus's bail-in to Zimbabwe's $100 trillion notes. The things most people rely on to protect them during normal times are built on systems that require stability to function. The moment that stability is removed, the value of those things begins to follow. This does not mean catastrophe is the inevitable fate of any particular economy. Most economies survive their crises. Most collapsed currencies eventually stabilize or are replaced. Most financial systems are rebuilt. Argentina is still there. Iceland, whose entire banking system collapsed in 2008, rebuilt itself into a functioning economy within a decade. But recovery is not the same as restoration. The years when savings were frozen or seized are not returned. The pension income that was restructured away is not reimbursed. The professional careers interrupted by emigration or industry collapse are not given back. And the trust that was destroyed, the confidence in banks, in governments, in currencies, and institutions, takes the longest to rebuild of all. The people who were inside those events, who built their lives on trust in systems that then failed them, carry those losses, regardless of what the aggregate economic statistics say about recovery. Understanding which things hold value when the systems around them fail, and which things only appear to hold value because those systems are functioning, is not an academic exercise. It is the most practical financial question any person can ask. Most of us spend our working lives building what we believe are walls against ruin. Savings accounts, pension funds, real estate, career credentials, professional relationships, business goodwill. And for most people, in most places, for most of history, those walls hold. The systems function, the trust persists, the assigned value remains real and reliable, but every wall rests on a foundation. And in economics, as in history, that foundation is always, ultimately, the fragile and invisible thing called collective trust. The professor in 1923, Weimar Germany did not make bad financial decisions. Elena, in 2001, Argentina did not take reckless risks. The Cypriot saver, who lost nearly half their deposits in 2013, did not fail to plan ahead. All of them simply trusted the systems that surrounded them. And all of them discovered in different ways, in different countries, in different decades, that the systems they trusted had their own breaking points. The breaking point is always the same. The moment collective trust crosses an invisible threshold and cannot sustain the value it has been assigned, everything built on top of that trust begins to fall. The wheelbarrow is gone. The question is what you are left holding. And more importantly, whether what you are holding would still have value on the morning when the trust behind everything else has disappeared.